From Morgan Stanley, it is Andrew Slimmon, and we're taking a look right now. Obviously, Tesla is our hot story, our hot stock. This is the Mag 7 year to date. Tesla is the laggard, down 33%. Let's just get an opinion on that. Mr. Slimmon, good morning. We're being attacked on all fronts here, aren't we? We've got Tesla under pressure. I mean, this is brutal. Down 5.5%, missing on the deliveries. We've got yield spiking by 18 basis points. Just a very first reaction to the Tesla news flow. Idiosyncratic to Tesla or something more malevolent?
Well, I think it's a good thing for the Mag 7 to be bifurcating based on fundamentals. If you look at the ones that are the winners and losers this year, it's all about fundamentals, and that was not the case last year. So overall, I think it's a healthy sign that the stock prices are reflecting what's going on in the fundamentals. And, you know, Tesla certainly, stock price and fundamentals seem to be going together.
So the bifurcation, I mean, you're going to hear people screaming from the sidelines, buy the dip on Apple, buy the dip on Tesla. The bifurcation will have ramifications in terms of performance for the rest of the year. I know that you've got a view on tech, and it doesn't necessarily coagulate around the top of the Mag 7, but you do like exposure in certain areas. How do you play tech?
Well, look, what's wonderful about this, what's happened recently, is if you think about the rally in the first quarter until early March, it was only a momentum, AI, weight loss drugs. It was all the same stocks. And then the market, those stocks kind of ran out of steam, but instead of pulling the market down, the market rotated into other areas like energy, financials, materials, industrials. That's a very good sign that people are looking for other areas to buy. And so I think, yeah, you want to own some tech names. I like some of the semiconductors that will benefit from the CHIPS Act. But I also like the cyclical areas of the market also, because I think this is not growth or value. I think it's a combination of both that you want. Now, I will caveat all this minutes by saying, look, last fall, when the conflict in the Middle East broke out, oil went down, and everyone asked me about geopolitics, and I said, I don't know, but I always watch oil. Well, oil is spiking higher. That means the concern by equities towards what's happening geopolitically is increasing, and that's something that we need to watch near term.
I mean, this oil price is rising. There we go. You're talking about the dangerous concentration and that movement in momentum stocks unwind, but it didn't have a brutal effect. The spike in oil this morning, let's talk a little bit more about that. How much of a challenge do you think that then becomes for the Fed? We'll talk about the Fed more broadly in a moment. But that oil spike, it's certainly not going to be welcomed by Jay Powell, nor the White House for that matter.
Without a doubt. Certainly the White House. You don't want to have people, being forced to fill up their gas tanks at higher prices right before an election. Yeah, I think it's a problem. My base case is always, look, I think it's better for equities that the Fed doesn't cut, because they're sending a message that economy is strong and they can be patient. I think that's a good sign. I'd be a lot more nervous if they were, hypothetically speaking, if they were cut tomorrow. I'd get really worried that they see something that we don't see. But if they're not cutting because oil prices are higher, that's an inflation problem, and that's a concern. We'll have to see how this plays out. Look, I've been in the business a long time, and I've heard the secular thesis on oil forever. It never pans out that way. It rolls over eventually because higher prices always brings out more supply. We'll have to see, but near term, this bounce, I think, is a concern for equities after a very good run.
Well, here's the issue, isn't it, about where we are with rate cuts. Right now, we have the market assuming less cuts than the dots. Who'd have thought that we got there so quickly? So now we're sub 3. June has been shredded to the toss of a coin. We have oil lit up like a Christmas tree. I'm sure we'll get more notes at $100 oil in our inboxes, both of us. How would you react if there were no rate cuts this year, Andrew?
Well, again, I think they would be forced to cut rates if the economy weakened. So if you told me at the end of the year there were no rate cuts, my first reaction is, well, that means earnings estimates for next year are going to start the year somewhere, 275, 280. If you told me that they were cutting 6 times, I would go, oh my God, they're not. There's no way earnings are going to start the year at 275. So again, I think a patient Fed validates that the economy is strong. That's better for equities because as you think about where will the market end the year, it's going to be priced off of what is the forward earnings estimate for the S&P. And right now, next year is in the 275, 277 range. And that validates upside in equities. But if they cut 6 times or whatever, then that gets me worried. And then it's tougher to see a lot of upside in equities.
Let's put Morgan Stanley against UBS. I had UBS on this morning. They said 5 rate cuts in 2026. The fatter tail risk is a slowdown in growth. The fatter tail risk is a slowdown in growth, a material slowdown in growth because we've extrapolated too far. Now, the other side of that trade is, of course, China's rebounding in growth. Caixin is strong. ISM in the US is strong. And we are dragging ourselves by our bootstraps out of recession in Europe. Does growth hold up? How do you look at growth? And do you play that cyclically? Is that I want to deploy more to cyclicality now because of perhaps this floor in growth?
Yeah, that's a great question. So look, in theory, as rates go up, inflation goes up. You want to play cyclical stocks, right? But if the market thought that the Fed was going to overstay their patience, you would see these stocks roll over, even though a little more inflation's good for them. And we're not seeing that right now. The best performing sectors the last 4 weeks have been the cyclical sectors. So the market is sending a message here that they think the economy can withstand Fed being patient. We'll have to see if that continues. But that's the message the market is sending. And so I think you do want to play these cyclical stocks because there is quite a bit of spread of valuation still between the cyclicals and the growth stocks. And what we're hearing from a lot of our cyclical companies is they have pricing power. They're raising prices, especially in the materials area. And that's good for the earnings.